It's not that any person is indispensable, neither is your equipment or your buildings or anything like that, but you certainly go and insure the rest of that stuff. And I think that we have to really continue to shine a light that this is not showing up on the balance sheet of the business. The key people who are actually generating the profits for the company. The machinery and the buildings are just tools to make all that happen, but it's the people that do it. The ability of key people in your business means the difference between profit and loss. Insure them, just like you insure your machinery, your buildings, your equipment. Insure those key people. It's not machines, it's not equipment, it's not buildings that make you money, it's people. So accountants are really great at assembling all of the items that need to land on a balance sheet. But the one thing that I still can't find anywhere on a company's balance sheet are the people.
Yeah.
And so when you think about how to create basically salary continuation packages, how to ensure there's a guaranteed market for your stock to be redeemed when you're no longer around, how to create policy for the tax collector and how to create one for the family, how to protect your joint venture partners if you're investing in real estate, that's a business. And so we want to talk about how to protect the money-making machines in whatever ventures you have. And the money-making machines are the people. And that's been coming up, Sarvlo, in conversations that we've been having with prospective clients who may not even know that you can do these sort of crisscross or seesaw arrangements where, think about our own company, like I have an insurance policy on where you're the life that is insured, the company owns it, the company pays for it. There's a number of tax advantages that come along with that. You own a policy where I'm the life that is insured. Your company pays for it. Your company owns it. There are a number of tax advantages associated with that. But what we've created is a guaranteed market for our stock when we're not around anymore. But I wanted to ask you, like, what comes up for you in these discussions that you're having with business owners and joint venture partners in real estate and just in general, like what's coming up around this topic?
So we'll meet with an investor and then obviously we talk about, some specific goals that they want to get accomplished by becoming a banker in their life, et cetera, et cetera. All the goals are tied towards financial growth, financial well-being, financial strength, confidence in financial ability, things like that. And then we take a deep dive into, okay, using an example of there's two people, let's just call them John and Smith, and then they've incorporated to buy, let's just say, a real estate project.
Okay.
Right. And then they'll say, yeah, we've secured the first mortgage from the financial institution. We went ahead and raised some extra capital because it was a big purchase. We got some private investors too. Here's a plan to pay the bank. Here's a plan to pay the investors. Here's a plan to make profit. Here's a plan to manage the property, the asset itself. But that not one person has ever talked to me about, here's a plan to manage the risk in case something happens to my partner who I'm really heavily relying on for their good guidance because they bring a ton of experience. Nobody talks about if that person disappears from planet Earth.
Yeah.
How are you going to manage the risk?
Well, especially if the one partner, well, both partners play a role in the deal.
Yeah.
But the ability of having that partner is the difference between profit and losing money.
Yes.
Right? And so both parties involved in the deal make that difference. And so you've got to assure that they're both taken care of to manage the risk, exactly like you just said.
Yeah, they talk about all the things, but the people, which really truly makes things happen, especially the JVs, the shareholders who are the key to the business, because it is their thinking that is making things happen, right? When we, ask some more questions, I said, hey, who's your JV partner and how young is the JV partner? And does the JV partner have a family? And in most cases, they're like, yeah, my JV partner has a spouse and they have kids and I'm married and I have kids. And I said, just think about a day, the worst case scenario, your JV partner disappears.
Yeah.
He owns 50% shares in the business, you own 50% shares in the business, or she owns 50% and you own 50%, doesn't matter. What happens to those shares? Who takes over the ownership of the share when your JV partner disappears from planet Earth? The shares are going to roll over to the surviving spouse. That's the most typical scenario that'll come up, right? Okay, so you are in business to go in business with the JV partner because JV partner has certain skill sets.
Yeah.
But now those shares are not with the JV partner anymore. It actually got rolled over to the surviving spouse. Do you want to do business with the spouse? Does the spouse have the same ability, knowledge, know-how, experience that the spouse will bring to the table? And in most scenarios, the answer is no. Like, that spouse is there because of my partner, my JV partner, and we have a great relationship as JV partners and friends. And that spouse may not bring the same experience as the expertise. I said, then what's going to happen to the business going forward?
Well, and the spouse, in most cases, doesn't want to have anything to do with that.
Exactly.
And so you want to create a guaranteed redemption for that stock. So look at it from this vantage point, just in general. If you had $100,000 and you put that $100,000 into a savings account at a conventional bank, and you were getting 5% on that money. So now you've got money making money, right?
Yeah.
So you would make $5,000.
That's right.
On that $100,000. If you've got a key person in a business and you're paying them $100,000, what kind of value are they generating for that business or that joint venture partnership? You think it's a little or a lot more than $5,000?
Oh, it's yeah, multiple times over than five. In fact, it's probably more than the $100,000 that they take from the business as an income. So
precisely. So when you lose a key person,
yeah,
you've created a significant financial loss. Whereas money just sitting there in a savings account is just money making money. We're talking about key people. And when you think about the business aspect, if you went to the bank, okay, and we say, hey, we want to borrow some money to expand the company. Well, the company is going to say, look, if you don't have your machinery, your buildings, and all of that insured, we're not doing business with you.
Yeah.
But rarely does that banker sit down and say, unless the two of you have coverage on each other, we're not doing business with you. And so it's not that any person is indispensable, neither is your equipment or, your buildings or anything like that. But you certainly go and insure the rest of that stuff. We have to really continue to shine a light that this is not showing up on the balance sheet of the business. The key people who are actually
the most important,
generating the profits or the company. The machinery and the buildings are just tools to make all that happen, but it's the people that do it, right? So one of the things I wanted to show you, I was having a conversation with a business owner, and this is the numbers that we were actually looking at. But the problem that we had to address, okay, what was the problem that we were trying to essentially solve for? And when it came down to it, we said, look, in your business, you presently have 3 key people. These are key people that really steer the earnings and drive the growth in the company. I want you to consider hiring a 4th key person in the business. And the business owner said, well, what are you talking about? We don't need to hire anybody. I said, well, I just want you to consider this for a second. Just consider hiring a 4th person in the business, and we're going to guarantee the stock redemption. So when you look at this is premium, okay? So This is what you're going to pay the 4th key person in the business. This policy is going to become a key person in the company. You're going to pay $50,000 a year. Now, what does that translate into? That's $137 a day. So you're going to pay this 4th key person $137 a day. So if you pay this small amount, I'm going to deliver this big amount, and you get to use this amount. And so the business owner said, okay, wait a second. Can you run that by me one more time? I said, yeah, absolutely. So I just showed him, honest to goodness, I just showed him 2 checks. And I said, look, you sign the smaller check to pay the 4th key person for this amount, $50,000. I'm going to deliver this amount, $1,036,000, and you get to use this amount, $44,714. How we doing? What if your key person lives past the first year? You sign the check for this amount. I'll commit to delivering this amount. You get to use this amount. Shall we continue? And so I said, look, the 4th key person in the company is never going to call in sick. It's never going to unionize. It's never going to complain about anything. It's just going to create capital. And then when you're gone, we have guaranteed stock redemption, because let's presume, God forbid, death occurred in the 3rd year. The company signed checks for $150,000. Agreed?
Yes.
The company had access to $145,000 ready access capital. 1.277 million gets delivered to the company in death benefit proceeds because the stockholder died. The company can now pay the surviving spouse, can redeem the stock and pay no tax on that transaction. The company can now use the residual proceeds to go and hire someone else so that they can keep the business going. They can keep the employees employed. They can keep all of those contracts in place. They can continue operating. And the company can never pay in what the insurance company is going to pay out. So the business owner looked at that from that vantage point and said, that falls into the no-brainer category. Let me get started, because who's paying the premium?
It's the company.
Because the company has the capital.
Yeah.
The company is just an entity. The key people are the company.
Mm-hmm.
And when we looked at the balance sheet, we couldn't find any of the key people on there. So why don't we bolster the balance sheet? Let's hire a fourth key person. It's not going to bend or break the company. We're maintaining liquidity. So when you look at this example, how much money have we put in to the policy?
$50,000 for 4 years, that's $200,000.
How much cash value has piled up?
$200,000 to 67.
How are we doing?
Well, we definitely cost neutralizing.
So we've neutralized cost, we've maintained liquidity because we have ready access to capital on demand on our terms. We're paying no tax on this daily buildup. The business signs the smaller check. We guarantee the delivery of a much larger one. There's no way that the company can ever pay in what the insurance company is going to pay out. And we don't jeopardize liquidity for the business. Isn't that the best fourth key person that you would ever want to hire?
Yeah, 100% with no cost of acquisition at all after 4 years.
You've got, after the fourth year, you're still signing the smaller check, but the accumulation in cash value is far greater if you were to isolate that on an annual basis. Let's just do that.
Let's pick year 5.
Okay, so at year 5, the company signs the smaller check for $50,000. We're guaranteeing the delivery of $1.517 million. Now, the annual increase in cash value from year 4 to year 5, so 258,757 minus 200, 267, that's $58,000 annual increase in cash value. We talked earlier about putting $100,000 in the bank and making $5,000.
Yeah.
So from that vantage point of the business owner grasps this very quickly, because the business owner says, well, look, what if I need to buy a new piece of machinery and the new piece of machinery is $150,000? So you no longer need to go and borrow the money from someone else's bank. All you need to do is request a policy loan from the life insurance company for $150,000. They place a lien on the death benefit, not the machinery that you're buying, and the company controls the repayment schedule. The total $258,000 of cash value continues growing daily, uninterrupted, while the machinery is enabling your key people to produce revenue. How much of the corporation's surplus capital do you not want residing there? Business owner said, look, how soon can we do that? The ability of key people in your business means the difference between profit and loss.
Yeah.
Insure them, just like you insure your machinery, your buildings, your equipment. Insure those key people.
Well, Jayson, typically in an organization, even in our organization, we always incentivize, our team members for doing a really, really good job.
Yeah.
And in this particular case, this fourth key person is actually providing incentive for the business owner to having this key person on their payroll after 4 years.
Exactly right. That's exactly right. And the other thing that I share, and you probably have this same discussion with business owners, joint venture, real estate partners, etc. I asked them, you're looking forward to living, right? And they say, well, yeah, of course. They say, well, I need to make sure that I'm articulating, because you know that your real estate ventures are going to grow. You know that your company is going to grow. And so what I'm doing on your behalf is I'm looking down the road. And so I want to make sure that as your portfolio grows, as your businesses grow, that we have the ability, contractually guaranteed, to continue writing a much bigger check when death comes. You're focused on living, which is wonderful.
Yeah.
And we're maintaining liquidity and ready access to capital while you're alive. My responsibility is to make sure that I'm looking down the road and taking care of that. Nobody wants to think like, oh, maybe death comes tomorrow. But the moment that that contract is in place, if death came the next day, the company signed the small check for $50,000, we're delivering more than $1 million. So we've guaranteed the stock redemption. We guaranteed the stock price. We've given the company capital to go and find someone who can continue helping the business grow. So everybody's taken care of.
And then Jayson, like guaranteeing the redemption of the stock value in this case, doing it our way is always going to be cheaper because it's going to be pennies and dollars. As you mentioned, the corporation will never pay more than what the insurance company is going to pay. And the alternate is if they don't plan about that and that day comes, because that day is going to come, we're all going to graduate one day, we're all going to become angels one day.
Yep.
And if there's no planning in place and the redemption has to be made, well, at that time, the redemption is going to cost $1 for $1.
That's a brilliant point.
Right.
Where's the money going to come from?
Yeah.
Well, it has to come from the company because the company is the entity that needs to redeem the stock.
Yeah.
And so if the company has the option to pay dollar for dollar out of company resources, or going back to this example, if I took that $50,000, again, that's the premium, and I divide that into $1,036,872, just call it 5 cents. The company's paying a nickel for every dollar. We are guaranteeing that we're going to return every nickel back to the company, plus we're going to return many, many more dollars.
Yeah.
So whose money do you want to use to redeem the stock? The company's money or the life insurance company's money?
Yeah. Obviously, life insurance companies is just...
Definitely. It's a no-brainer. But
Yeah.
nobody's talking to the joint venture partners or the business owners about this in that context. The context is about, let's make sure that we cover you in the event of premature death. We're saying we're dealing with a permanent problem, not a temporary one. We don't know if you're going to die tomorrow. We're asking the company to put up a nickel for every dollar of guaranteed money. How many dollars does the company want to buy at that price?
Yeah, if 5 cents is what it takes to buy $1, how many 5 cents do you want to put in?
And you're going to neutralize it, and then you're going to have ready access money. So we're not trapping that capital in a vice somewhere. We're maintaining liquidity, and the corporation calls the shots. Like, how many dollars do you want to buy at a discounted rate? And the business owner grasps that. But the industry at large is going into comparison mode, or just really, for the most part, just entirely off track. The business owner is like, look, what am I getting in exchange for deploying company resources called money? What am I getting in exchange for that? And we just described it, and then some. What business owner or joint venture partner logically is going to look at that and say, wow, that's a really stupid thing for me to do with capital?
I think the real problem that a business owner or a JV partner that they have are the problems that they haven't actually experienced yet.
Yeah.
And when we meet with business partners or business owners and JV partners, the feedback that we get from them is we never even thought about it the way you guys are describing it, because like you mentioned, Jayson, nobody's talking to them about it. The business owner or the investor or JV partner, they're really good at what they do, which is to grow the business or to grow the investments. And that's their laser focus. And that's where the mind goes every day, 24/7. They're just thinking about that.
Yeah.
And when they have us as the strategic partners on their team, as let's just say wealth coach, we come in and we shed a light on things that they haven't considered. And then that becomes a light bulb moment for them. And they're like, this is why we are here today.
Yeah.
You should get this kind of expertise and guidance going forward so that you guys are seeing things that we haven't seen, and we want you as a partner alongside the journey.
It's exactly right. As business owners ourselves and having done this ourselves, we recognize all the advantages that it represents. But for everybody who's watching this content, it's recognizing that it's solving problems that will come, not a matter of if, but when. And going back to that business owner for a second, I said, well, let me take you out to, suppose you die 10 years from now. Let me take you out to the 10th year. Let's just have a peek and see what's going on. How much money did the corporation put into the contract?
50,000 multiplied by 10, that's $500,000.
So that's $500,000 that the company put into the contract. The total cash value of the policy is $609,507, and the total death benefit is $2,125,657. So business owners, suppose you die in the 10th year. Your company utilized $500,000. So there's a $500,000 policy loan balance outstanding. So did the corporation spend everything that it put in to the policy?
100%.
Corporate owner dies. There's a lien on the death benefit for $500,000. So we take the $2,125,657 death benefit, we subtract $500,000. $1.625 million is being paid to the corporation in the form of a death benefit. That gives rise to the capital dividend account inside of the corporation, which is a notional account, but the account is credited, and then the surviving shareholders can receive proceeds in the form of tax-free capital dividends. But let's presume that as stockholders, they had all agreed, well, we want the corporation to be reimbursed for everything that it put into the policy. So let's subtract another $500,000. Now we have $1.125 million. Corporation says, well, we need $100,000 to go and hire someone. So now we've got $1.025 million to distribute to the surviving shareholders, and we can do that in the form of tax-free capital dividends. If the corporation did not have the policy, so let's just go zap, the policy's not there. Corporate owner dies. The corporation is $500,000 in debt. What happens now? The corporation has to still continue servicing the debt. Agreed?
Yep.
The corporation now has to figure out a redemption plan for that deceased shareholder's interest in the business. So now the corporation has to either A, figure out, are we going to dig into the company coffers to deal with this problem, or are we going to try and borrow money to redeem the deceased shareholder's stock? Either way, does that put the company in a worse financial position?
Definitely will.
Did the policy solve all those problems?
And
in an instant.
Yeah, 100%.
And we increased the corporation's value. We created an asset on the balance sheet, and the corporation paid $500,000 for it and got out of the deal with no debt, full stock redemption, more than enough capital to go and hire another key person to recruit somebody and pay them well. All the problems have been solved.
Yeah.
And it was the life insurance company's money that solved the problem, not the corporation's money.
Again, if the planning is in place, then the corporation is going to be in a proactive nature at that time.
Yeah.
And if there's no planning in place, then the corporation and other shareholders on the business are going to be in the reactive mode. And that's just not good time to be operating the business, because let's just say the corporation at that time had no money.
Yeah.
Well, then they had to go on and take on some more debt from the third-party bankers, and corporation may or may not qualify for that debt at that time. And that's just going to be even worse than what we're describing today.
Again, we just don't know anyone's best before date. You know, you find that stamped in every food product that you buy. It's the best before date. No human being is born with that stamp on them somewhere. And so, but we know that's going to come. So you have a policy, premiums are paid, cash value is piling up daily, uninterrupted, can't go backward. We get full recovery of cost. It's not a matter of if, but when, because you can never pay in what the insurance company is going to pay out. So you get full recovery of cost, maintain liquidity, ready access to capital, to grow your company, to grow your portfolio, to expand your horizons financially. And then when death comes, we guarantee the delivery of money, and we guarantee the delivery of far more money than the company or the key people. If you're doing a crisscross kind of a seesaw arrangement, where if it was just a two-person partnership and I said, Sarbalo, I'm going to pay the premium personally to insure your life. And Sarbalo says, hey, I'm going to pay the premium personally to insure Jason's life. Well, we guarantee the delivery of far more money neither one of us put in.
Yeah.
And it all happens on a tax-free basis. So the only loser in that scenario is Revenue Canada. How many discounted dollars does one want to buy, knowing all the problems that this insurance contract solves? But the people watching this have to recognize, if they're a business owner or a joint venture partner in some shape or form, they have to recognize that there's a problem so that the solution actually matters to them.
And if the solution doesn't cost anything and just creates and truly creates a solution, then it's worth considering it.
All day long. And so I think that, again, being biased, just going into our 16th year in this journey, much like our clients just all across the country and now in the United States, where we're serving people in the US as well, nobody's calling and saying, I'm really frustrated that my cash values keep rising every day. And I'm really frustrated that I've fully recovered cost in these contracts. I'm really frustrated that, God forbid, if my business partner wraps his car around a tree, that we're going to have more than enough money to take care of everyone and everything. And we don't have to send any checks to Revenue Canada from the company coffers. No brainer. You can create a guaranteed market for your business. You can create guaranteed stock redemption. You can create a policy for the tax collector and a policy for your family. You can create a salary continuation package. You can create a package to ensure all of your company's credit, all of your company's debt. That's the one thing that we've been talking about, Sarblo, is these packages. And we'll put it together for you.
Yeah.
All you need to do is get connected. All of the information that we share doesn't really matter if no action is taken. And so get connected with the right person on our team, and we will help solve your problems.
It's really good, Jayson. And the link to get connected is going to be underneath this video in the description. Yeah. And you should click on that link because of all the packages that Jayson talked about, which we have, which are going to solve all the problems that are definitely going to come. That's why you should go click that link.
You heard it best for Sarblo. Click the link. Take action. You'll be glad you did. And you're going to see another video that pops up. We want you to continue your journey of learning. And so we've recommended this next video for you to continue watching, continue growing and learning. And we look forward to hearing, your success stories with this process.